Good morning, everyone. I'm Wes Burke with Central Coast Lending. Here's the mortgage capital markets briefing for Monday, August 17th. The headline this morning is that the bond market is under modest pressure, but the more interesting story is where that pressure is coming from. The 10-year Treasury is around 4.7%, and the UMBS 5.5 coupon is near 99.36, down about 0.03 of a point, or roughly one tick. Mortgage News Daily's daily 30-year rate is sitting around 6.73%. This is not a panic move. It's a slightly weaker MBS tape, and it argues for patience rather than complacency. The first driver is oil and Iran. Crude is a little higher as diplomatic progress remains limited. WTI is around $82.50, and Brent is near $88.85. That matters because energy prices feed inflation expectations, and inflation expectations feed the long end of the Treasury curve. Mortgage News Daily noted this morning that bond yields popped after headlines suggested Iran was moving toward a more offensive posture. The move wasn't huge, but it's another reminder that a geopolitical headline can change an otherwise quiet rate sheet very quickly. But there's a second story that may be even more important for mortgage rates. The long end is staying stubbornly high even after softer U.S. data. Reuters has the 30-year Treasury near its highest level since 2007. The market is wrestling with fiscal concerns, heavy corporate bond supply tied to AI investment, and a buyer base that is more price sensitive than it used to be. That helps explain why the 10-year can sit around 4.7% even while markets reduce expectations for another near-term Fed move. Softer economic data is helping the front end more than it's helping long-duration bonds. And mortgages live much closer to that long duration conversation. Now to the mortgage basis. Using MND's 6.73% mortgage rate and a 4.705% 10-year, the simple mortgage to Treasury spread is about 203 basis points. Freddie Mac's latest weekly survey is 6.67%, and MBA's latest conforming rate is 6.77%. Those surveys are measured differently, but they put the public mortgage to Treasury relationship in roughly the same neighborhood. One important distinction, that 203 number is not MBS option adjusted spread. Think of it as an LO-friendly primary rate to Treasury proxy, not a Wall Street OAS calculation. Here's the inside baseball point today. Optimal Blue's July capital markets data showed that UM30 5.5 was the dominant hedge, representing 67% of hedges. At the same time, 35% of production was slotting into the 5.5 coupon and another 24% into the 6.0. Conventional best efforts to mandatory execution spreads also tightened to about 30 basis points. That tells us the 5.5 coupon isn't just something we're putting on a slide. It is where a substantial amount of actual lender pipeline hedging is taking place. On the origination side, July purchase locks were down 12% month over month, while rate and term refinance volume fell 17%. Refis were only about 19% of production. That suggests refinance-driven prepayment pressure is still relatively contained at current rates. The bigger message is that borrowers remain extremely sensitive to relatively small changes in rate. For the lock desk, my bias today is balanced to defensive. For loans closing inside 15 days, I would lean toward protecting the deal rather than gambling on a geopolitical headline. For 15 to 30-day files, floating can make sense only with active monitoring and a clear reprice trigger. Longer dated borrowers have more room, but this is not a set it and forget it float environment. Tomorrow brings housing starts and industrial production. Wednesday brings the July FOMC minutes and a 20-year Treasury auction. Thursday brings a 30-year TIPS reopening. And then next week, we get the big cluster: GDP revision, PCE inflation, and durable goods. Bottom line, MBS are only modestly weaker today, but the 10-year is testing the 4.7% area, and the long end is refusing to rally as much as softer data would normally suggest. That makes this a market to manage, not predict. Stay close to your floating borrowers. Watch MBS, not just the 10-year. And use any intraday improvement as an execution opportunity rather than a promise that rates are headed straight down. One more thing before I go. If you're a producing loan officer, we're building something you'll want to hear about. It's a structured, compliant office access platform that puts the right loan officers inside select real estate brokerages on a published schedule with the brokerage's blessing. You bring the relationships. Central Coast Lending brings the banking platform, the compliance structure, and a formal way to deepen what you already have. If you're tired of being told to go build realtor relationships from scratch and you want a program that formalizes what you already have with a local mortgage bank behind you, give me a call. Let's talk.